Folks, today we are going to be looking at the second part of the risk and return CMA part 2, right? So we were looking at risk and return yesterday. What's risk, what's return, what's the relationship, how to calculate a basic return and risk metric. Okay, so now we're going to take it a little bit further and calculate the cost of equity, and this is an important concept, right? Using capital asset pricing model or CAPM. CAPM, capital asset pricing model. But before we get into this, I want to talk a little bit about the risk of a portfolio, types of risk, and then come and deal with CAPM. Okay, so before we go into CAPM, let's take the example of investing in a stock market, right? Let's assume this is the Indian stock market. You have 10,000 rupees with you and you want to invest. Let's pick a stock like, say, Reliance. And you are putting all your 1,000 rupees in that stock, right? So you have 10,000. You're putting it in Reliance stock. So yesterday we saw how to calculate the return. So at the time of investment, you have 10,000. After a year, let's assume there was some kind of an incident with Reliance. Maybe one of the factory had a strike or a fire, something relevant specifically to Reliance happened, and the stock tumbled. So you lost, let's say, 10% of your money. So the 10,000, which is in time 0, became 9,000 at time 1. So you had a loss of 1,000 rupees or a negative 10% return. So remember how we have to calculate the return. It is investment at time 1 minus investment at time 0 divided by the initial investment. So which would be minus 1k divided by the initial investment of 10k, which is 0.1, and in percentage would be 10% negative. This is all negative, right? So 10% negative is what has happened. Why did this happen? Is it because the market scenario, the market tanked? No, it happened because of something specific to Reliance. So this we call as non-systematic or idiosyncratic risk. Idiosyncratic, it is specific to Reliance. It is not related to the market. Let's assume you didn't do this thing. Instead of this 10,000 in Reliance, you invested 5,000 in Reliance and another 5,000 in, let's assume, Infosys. The market did well overall, and Infosys also benefited from that, right? So the same thing happened with Reliance, though. Reliance is still down 10%, even though you have invested in another company. This would have gone down by the same negative 10%. So you will be having 4.5 thousand. Infosys, on the other hand, did well. It gained 20% in that year. So the 5,000 has now become 6,000. So this is plus 20% and this is minus 10%. So net, at the end of the first year, you have 10.5k. Look at that. When you had 9k here, and you have 10.5k here. So by this inclusion of Infosys, what has happened? You have lowered your risk. Because this was a specific risk. When you add another company, you are diversifying that risk away, right? So diversification has lowered this non-systematic or idiosyncratic risk. But there is another risk. What if there was a war or there is an earthquake, there's a huge inflation, high inflation, and the entire market collapses? We can't do anything about that. If the market went down by 30%, entire market, would Infosys be unaffected? Most likely not, right? So that is called as systematic or market risk. So when it comes to stocks in a portfolio, these are the two main risks that we need to worry about: systematic and unsystematic or non-systematic risk, right? So specific risk you have, and then you have the market or systematic risk. Okay. So, are you going to be paid to take specific risk, or are you going to be paid to take market risk? Think about it, right? As a market, it gives you the opportunity to eliminate specific risks. You can diversify into n number of companies and make this idiosyncratic risk go away. This strike or this fire is not going to happen in 20 other companies. It is probably just going to be one-off scenario. So you can spread this 10,000 not just in 2, but maybe 10 companies, 1,000 rupees in 10 companies, and then this impact from this specific risk will go away. Right? So this is one of the key understandings for us to look at CAPM. Because in CAPM, we are going to calculate the cost of equity, that is the required rate of return to invest in a particular project or a particular stock, security, etc. We are talking only about the equity component. So this might be investing in a particular stock or company, but it could also be even within a company investing in a particular project, and you can still use CAPM to understand the required rate of return. Alright, so we talked a lot about this, so now let's jump into CAPM. Okay, so now that we understand there are two types of risk that we have to consider, one that can be diversified away and one that you can't do anything because it is something that affects the entire market, right? Something that happens with the macro environment, etc., right? So we can't do anything about that. So now let's figure out, let's say I want to invest in a company, let's call it Tata Consumer Products. I used to like Starbucks a lot, so Tata Consumer, it's one of my favorite stocks. Anyway, so let's say we want to figure out how much to pay for this particular company, right? What is the return expectation I have? So let's assume this company is now trading at 500 rupees. What should it give me next year, after a year, for me to make it a part of my portfolio? The minimum return, I'm expecting from this company when I am investing, or the expected return. So let's go back to yesterday's class. We talked about what is risk-free rate. Risk-free rate. So risk-free rate is the money when you invest with a bank, with treasury bills, with government bonds, etc. You are guaranteed to get the money back plus the interest or additional return, right? What is that additional return you get? Without taking any real risk, almost zero risk. That is risk-free. So we said 3% was the savings bank interest rate. It's backed by some kind of FDIC insurance or some kind of government backing there. So we are assured that if we invest 10,000, we will get 300 rupees back as interest, right? 3% on 10,000, so you're going to get 300 at the end of the year. Okay, so that is for without any risk. Now we are going to talk about taking on risk. Let's say we are going to invest in the stock market. Yesterday we said the expectation might be like 12%. 12%, right? Because stock market has risk. This has no risk, this has risk. So this is what we call as the market return. This is risk-free return, this is market return. You are expecting the market to give you 12% to be able to invest in the market. So this is, we are assuming you are risk neutral, right? This is the price at which you're willing to invest in the market. So this difference, 12 minus 3, which is 9%, is the premium you are expecting to take that additional risk. So this 9%, we will call it risk premium for participating in the market. So it is market risk premium. Market risk premium is 9%. So you need additional 9% to take part in the market. Now let's go back to Tata Consumer. If I have to invest in Tata Consumer, that is also part of the stock market, will I be happy with just 12%? Most likely not. Most likely not. Right? Because Tata Consumer is a high growth stock. Its beta we said is a measure of the risk, the measure of market risk. So Tata Consumer, let's say its beta is 1.5. So the beta is 1.5. So what is beta? Beta shows the correlation of return of Tata Consumer with the market. So if the market moves in terms of the equity risk premium that we are getting, if the market moves X, Tata Consumer will move 1.5x. It will happen on the negative as well as on the positive. This is based on tracking of the relationship between the market return and this particular stock. So let's say here we got 9% as the risk premium. So if Tata Consumer is 1.5 times riskier from a market standpoint, I need to get 1.5 into 9, right? Whatever that is. So 13.5% as my stock premium. So this is the market risk, and then you see I need to get an additional 4.5% to be okay with investing with Tata Consumer. So if we have to write this as a formula, CAPM, which is going to give you the required rate of return, you can say it is the risk-free rate, right? So initially, this is for taking no risk. Anyway, you will get it, right? Risk-free rate. Plus, you have to add the market risk premium. Market risk premium let's call it RM minus RF, correct? So it is RM minus RF, the 9%, right? The market risk premium. But you also have to consider the individual securities beta, the correlation they have with the market risk premium, right? So we can say it is risk-free rate plus so in this example that we just looked at, it's going to be 3% plus 1.5 into 12% minus the 3%. So 3% plus the 13.5 that we already calculated. So we need 16.5% to invest in Tata Consumer Products. So what was 3% requirement for me to invest in a savings account became 12% to invest in the broader market, like let's say Nifty index. And from there it became 16.5 to invest in Tata Consumer Products. So this is CAPM. So we can calculate the rate of return required to invest in a specific stock, or it can be also in an individual project in a company. From a CMA standpoint, that is what's more relevant. Let's assume you are a conglomerate and you want to evaluate a project. Then you will take the data of that particular vertical. Let's say you are Reliance and you want to invest in the telecom. You will pick a comparable beta. You will look at a tradable pure play company like Airtel and see what is the correlation with the market and figure out that, maybe make some adjustments for the risk of the project and calculate the cost of equity or the required rate of return. I hope you understood that. Maybe if you're not sure, leave a comment or a question below. I'll be happy to answer that. All the best. See you.